the shareholders or the public shares are very limited in Germany. Things are changing after foreign investment is also coming to Germany and they are getting modified. And we have discussed about how that type of operation is going on. And we have also discussed about employees' representation in the board. Now, this German corporate governance model is directed by Industrial Democracy Act and Law on Employee Co-Determination. Actually, if you see the heading Industrial Democracy Act, that is why 50% workers' representation and 50% investors' representation. So that is what is democracy. And then the law on employee co-determination. So employees can determine the fate of the company. So that is the heading of these two laws. These regulate the size and determine the composition of the supervisory board. Because supervisory board is prime. Managerial board is put up by supervisory board. So if supervisory board is decided, then managerial board can be managed. So what are the guidelines? In small corporations with less than 500 employees, shareholders elect the entire supervisory board. The bank has the full power, or the one who has invested has full power. Employees do not have power. So that 50-50 is only for bigger companies, not for small companies of 500 employees. See here in German model, the capital investment is not mentioned. It is only employee related. So that is why employee co-determination. So less than 500 employees, the employees have less say. These investors have more say. In medium-sized corporations defined by assets and number of employees. So next comes definition is now they have included capital cost and also number of employees, which is more than 500. Employees elect 1/3 of a 9-member supervisory board. The total board number is 9. So they will select 3, 6 will come from the bank. And for large corporations, that 1/2 and the total board strength will be 20 and 1/2, 50-50 by the employee and the organization. So bigger corporations, which matter really in terms of economy, they are equally controlled by employees and investors. In Germany, both federal and state law influence corporate governance. In US model, we have seen that a company is registered under the state law. In India, it is central law. But in Germany, both state and central law can influence the corporate governance. Federal laws are the stock corporation law, stock exchange law, and commercial law, as well as the laws governing the composition of supervisory board, which we have read in the previous slide. Then regulation of Germany stock exchange is, however, the mandate of the states. So stock exchange are under the state law. So every state has its own law for managing the stock exchange. So that is how corporate governance in Germany is influenced by both central and state law. A federal regulatory agency for the securities industry was established in 1995. Like we have a SEBI, or which controls on a central basis. There is a federal agency. Federal means central agency, which looks into investment, securities. Securities can be anything in industry. So whatever investment somebody is doing, that was in 1995 that a regulatory agency started. You can see, if whatever historical perspective I have given you, that CG, corporate governance, has evolved somewhere around 1990s. And it is now still evolving and maturing. So in India, at least, you will see many laws getting amended, changed, new clarifications being given. That is all. In Germany, corporations are required to disclose a wide range of information in the annual report and or agenda for the AGM. The corporate's financial data required on semi-annual basis. Anyone knows what is the frequency of sharing corporate financial data in India? In Germany, it is once in 6 months. What is the frequency in India? Any idea?
Once in a year, sir.
Once in a quarter. Okay, the annual report is one. But every quarter, if you go through,
Yes, sir. Sorry, sir. This is Subrat Kumar. Once a year, and it should be 4 month. One meeting should not more than
it is
4
not
months.
once in a year. It is every quarter you have to.
Quarter, you have to maintain it. Should not be crossed 120 days. I mean 4 months.
No. 120 days for board meeting. That is
Yes.
another.
Yes.
But financial data is every quarter. Every quarter you have to publish. Audited, some not audited, whatever, but you have to publish every quarter that. And or you have to at least furnish to the stock exchange. And it is done. It is done on regular basis. You will see many big corporations, they they also advertise in paper. They give their financial data in paper, at least the basic parameters. But annual is mandatory. And annual comes in, you will see in most of the newspaper in Financial and Economic Times, Financial Express and Economic Times, every big corporation in India, they will flash their financial statements quarterly and even annually. Data on capital structure, limited information on each supervisory board nominee, including name, hometown, and occupation affiliation. So supervisory board members, these details, including name, hometown, and occupation affiliation, has to be given. In India, there is still more. We will see when we go to Indian model. Aggregate data for compensation of the management board and supervisory board. You don't have to give individual compensation for all the directors. You can give an aggregate data. Any shareholder holding more than 5% of the corporation's total share capital, you have to give their name and address and all, like the including name, hometown, and other occupation. So significant holding is 5%. That is what below 5%, the names need not be disclosed. Information on proposed mergers and restructuring. It is there in most of the corporate governance structure. Propose amendments to the articles of association, the names of individuals and or companies proposed as auditor. The difference from the US system. Semi-annual disclosure of financial data compared with quarterly disclosure in US, which is same as in India. Aggregate disclosure of executive compensation and supervisory board compensation compared with the individual data on executive and board compensation in US. In India and US, we have to provide individual compensation of each director. No disclosure of share ownership of members of the supervisory board compared with the disclosure of executive and director stock ownership in US. You need not give any disclosure of, if only it is, if more than 5%, you can give. Otherwise, there is no need to give. In Germany, corporations are permitted to amass considerable reserves. These reserves enable German corporations to understate their value. This facility is not available in US GAAP. This means, because see, the banks are financer or equity holder in most of the company. Now, the profit of the company, if it is shared with the bank as dividend, it is okay. If it is not shared also, it is okay, because the money remains with the owner in a way, because they are the owner of the company. But in US, in India, in UK, where the owners are separated from the day-to-day operations and all. So their only way of earning is profit, which can be shared as dividend. So in India and US and UK, dividends are to be paid. In Germany, it may not be paid. I mean, they can pay less and keep more. And that also helps them in understating their value. But in a way, it is not good in the sense, suppose somebody wants to buy or take over, then you face difficulty. Next is Japanese model. This diagram also, it more or less is same to Anglo-US, but here you can say there are two things. Banks can control board when the company is not performing properly. Otherwise, in normal times, banks are only shareholders. Banks invest in EA. They don't directly come into the board, unlike German. And you have independent auditors, then there is no double board. It is only a unitary board, which is, now tell me what is auditors and independent auditors. Why there are two arrows? This auditor is internal auditor who does all the checkings on day-to-day basis. This is the independent auditor which evaluates the data quarterly or semi-annually or annually, and is reporting to the board.
Sir, I have one question. What is IFC audit? जो recently it has been implemented, I think 2 years back.
What?
IFC audit has been implemented last 2 years back. What is that, sir?
I don't know. What is IFC?
Internal financial something. It has been implemented just last 2 years, not before that.
Implemented what? How? Is it as a law, or it is has been
It is
asked?
as per law. It is as per law, sir. We have to maintain at least. Every organization has to maintain this
What?
IFC. Internal auditor, as usual, IFC audit, and stat auditor.
In India, there is no third auditor. It is only either internal audit or final audit.
No,
In
sir.
India,
IFC
there
audit.
is no
I'm sorry, sir, but
IFC
IFC audit
audit
has
may
been
be a
implemented.
method of auditing. IFC audit is not an auditor. See, in the corporate governance structure, there is no place for another auditor. It is only one auditor in India.
Yes, sir. That I knew. It was since beginning internal and statutory auditor. But
Internal auditor is not a statutory requirement in India. Internal auditor is a departmental thing.
yes, sir. That will be help to management.
In India, the statutory requirement of auditor is only one.
Yes, sir. You are right, sir. But internal auditor it is only for help to management. That I do. But last
It
2
all
years,
depends. It all depends whether the company wants or doesn't want. If they
yes,
want,
sir, I totally
auditor,
agree. Yes, sir. Totally agree. It's depend to organization.
see,
If
IFC is internal financial controls.
yes.
Okay, it is under Companies Act or 143 section.
Exactly, sir. It is, I think, implemented last 2-3
It
years
is
back.
nothing. It is nothing. It is not an auditor. It's a clarification how the auditor should work.
Okay, got it, sir. Okay.
So it is not like they are not a separate institution.
Got it, sir. Got it. Thank you.
So that is what is. So as per section 134 of Companies Act 2013.
Yes.
Internal financial control, IFC. It is not audit. It is IFC, internal financial control. Means
Yes,
the
sir.
policies and procedures adopted by the company for ensuring orderly and efficient conduct of business, including adherence to company's policy. See, I don't know if you remember in module 1 we have said about controls.
Yes, sir. Yeah, I can recall that. Yes, sir.
So this is what is only a guideline. This is nothing. There is no statutory requirement that IFC auditor is there. No, there is no IFC auditor.
Yes, sir.
Be clear.
Yes,
There
sir.
is
But
one auditor.
it does not mandate for every organization, right, sir? It's not mandate for every organization as choice of organization, right?
Which one?
IFC.
IFC is a clarified way of doing business, control for financial things. So it is part of the law. Like, 4 meetings a year.
Yes.
There could not be a gap of 120 days between 2 board meetings. These are all mentioned in the law.
Yeah,
so,
right, sir.
Internal financial control, measures for internal financial control, there is a guideline that you should do like this. You can do more or you can do only that. It all depends on the company. So it is not like it is something which is statutory, some violation, nothing like that.
Yes, sir. That it's not statutory or but I just wanted to clarify that what is it, because it is as per Company Act 2013, but it has been implemented since last 2-3 years back. I think what I
no, it has been there from 2013,
yes,
and you have to follow that. It says it is now giving some rather than saying people do like this or do as per something, they are now trying to clarify. As I have said, that if you have a non-executive chairman, you will see in Indians when we come to other slides, for a company, Indian company with non-executive chairman, it is mandatory that you should have this much of independent directors. So IFC is nothing like that. It is only a guideline to carry out your financial control things. Okay. It is so it's only you can say it's like best practices, something like a recommended best practices for internal financial control.
Okay, sir. Got it, sir. Thank you.
So we were talking of Japanese model. Okay. The Japanese model is characterized by a high level of stock ownership by affiliated banks and companies. And I think if you remember in German model also, corporations are allowed to hold shares in other companies. In Japan also it is same. And the holding by a bank also is same in Japan. In Japan, the banking system is characteristic by strong long-term links with corporation. Japan also has a legal public policy and industrial policy framework designed to support and promote kiretsu, industrial groups linked by trading relationship as well as cross shareholdings of debt and equity. Any industrial group, two industrial group having trading relationship can have cross shareholding of debt and equity. So, and it is termed as kiretsu. So, by that, a corporation is allowed to invest or hold share in another corporation. In America and in India, this is not possible. The main bank system and the kiretsu are two different yet overlapping and complementary elements of Japanese model. Almost all Japanese corporations have a close relationship with a main bank. The main bank provides its corporate client with loans as well as services related to bond issues, which is not allowed in India. Bond issues, equity issues, settlement of accounts, and related consulting services. Here, banks only provide loan. They do not do all these. Banks have sister concern who are dealing with this type of services in India. In US, the anti-monopoly legislation prohibits one bank from providing this multiplicity of service. In US also it is same. Instead, these services are usually handled by different institutions. Commercial bank, loan, investment, commercial bank handles the loan, investment bank, equity issues, specialized consulting firm, proxy voting and other services. In India also it is same, but in Japan, bank can do all this. The board of directors of Japanese corporations is composed almost completely of insiders. There is no executive and independent director type of thing. That is, executive managers, usually the heads of major divisions of the company and its central administrative body. The number of directors are also quite big in Japan. If a company profits fall over an extended period, the main bank and members of kiretsu may remove directors and appoint their own candidates to the company's board. Another practice common to Japan is appointment of retiring government bureaucrats to corporate boards by the Ministry of Finance. In the Japanese model, the composition of board of directors is conditional upon the corporation's financial performance. Means having a good company, making profit, doing well, can have a different type of composition, can have executive directors who are full-time employees also. But if the company doesn't perform over a period of time, then it will be taken over. Like in India, our Ministry of Company Affairs, MCA, can take over a company in case it defaults or becomes NPA or there are some irregularities. There have been cases like Satyam Computers, it was taken over and then handed over, was taken over by Mahindra Tech. Similarly, Yes Bank the management of Yes Bank was also taken over because of financial crisis, and Mr. Rana and all who were managing the bank were removed. So in contrast with the Anglo-US model, representatives are unaffiliated shareholders. That is, outsiders seldom sit on Japanese board. Unaffiliated shareholders do not come to Japanese board because all are insiders. Japanese board.
Sir, I have a doubt.
Tell me.
Sir, is NPA and insolvency same? Company insolvency and NPA?
Motamoti same.
Okay, sir.
Overall, it is same. NPA is non-performing assets. Okay.
Yes, sir. Yes, sir.
Insolvency becomes when that even you cannot. Suppose there is first it becomes an NPA.
Okay, sir.
Who else is speaking? Please mute yourself. One who is asking, please keep your mic on. Rest other, please mute yourself. So when you fail to repay some loan within a particular time, then you are declared as a NPA, non-performing asset. After that, suppose you come back again, you do proper things and you can. Whose question was this?
Sir, myself.
Vivas?
Vivas, yes, sir.
Okay. Rajesh Kumar Raut, you should switch off then your mic, please. If you when you want to ask something, please put your mic. So because that is what
Sir.
when you fail to repay loan, then you become an NPA. But suppose a company says ki,
Hmm.
in no way I can run my business, then they can go for insolvency.
Okay, sir. Sir, after once a company is declared as insolvency, will it overcome from there?
Have you heard of Go Fast Airline in recent times? Go Fast
Yes, sir.
Airline declared itself as insolvent and approached NCLT for starting the insolvency process. And after that, they themselves came up with a plan to run that. And now they are waiting for DGCA clearance and they will start operation once more. It all depends, depending on the financial situation and all, you can do that.
Okay, sir. Okay, sir. Got it.
Japanese boards are generally larger and it can contain about 50 members. So there can be 50 directors. In German, we have seen 20 maximum. And similar is in India and US also. So the Ministry of Finance and Ministry of International Trade and Industry are influential in developing industrial policy in Japan. These ministries also wield enormous regulatory control. These are the two important ministries for industry in Japan. Due to internationalization of Japanese corporations, they are less dependent on their domestic market and therefore somewhat less dependent on industrial policy. Similarly, foreign investment is also bringing in global rules. Like, Toyota, whatever car it is making in Japan is nothing compared to what they are making in US, India, and other places. So, Toyota's economy will not much depend on the policies of Japan. Similarly, Sony, they are everywhere. And they're into even filmmaking in Hollywood. So that is what it is trying to say. Because of their spread in Japan and their revenue coming from other countries also, these rules and regulations doesn't influence them much. But they have to obey the corporate governance structure. They can't go out of it till the time they are registered in Japan. Suppose Sony Corporation, which is a Japanese company, it starts an office in India, Sony Corporation India Limited. Then this company will have to follow Indian corporate governance system for its day-to-day work and all. Disclosure requirements in Japan are relatively stringent, but not as stringent in the primary regulatory bodies are the Securities Bureau of Ministry of Finance, which controls the share market and all. Then another is Securities Exchange Surveillance Committee, established under the auspices of security bureaus in 1992. You can see 1990. Please switch off your mic. Disclosure requirements in Japan are relatively stringent, but not as stringent as the US corporations are required to disclose a wide range of information in the annual report or agenda to AGM. Now we are coming to Indian model. See, depending on the culture, depending on the way things operate, depending on the state of economy, these rules do change. So in America, which is like is a different society as compared to Japan, the requirements are different because it all depends on how the society also at large operates. Okay, now we'll come to Indian model. In India, we have three types of companies: private companies, public companies, and public sector undertakings. All three have different requirements, and that is how they have different board structures. Now, after the Companies Act 1956 and now 2013, which is amended in 19 and 20 also, there are a guideline to that. But still, when we talk of a company like Reliance, Adani, Hindalco, or Aditya Birla Corporate Company, or Mahindra and other big names, they are all private companies which is owned by a some promoter. They are the main shareholders. And that is how their corporate governance is decided, because that one man is enough for deciding many things. Though they will have a board, they will have a CEO, CFO, everything will be there. But basically they are the main person. They can say yes, no, and the company will do that. Then public companies. Public companies are who have issued share, whose shares are traded in the exchange, and public sector undertaking, which are 100% government of India subsidiary or government of India company, where the president of India is the sole shareholder. But again, these companies also have to follow the laws or the rules as per Company Act. But the governance model is different. The corporate governance model in India has developed around three types of these three types of ownership, and it has adopted from Anglo-American and German model. This is how the corporate governance structure in India has grown. Companies Act 1956 was the first stepping stone. Then 1997 and 98 CII brought a code of corporate governance. I have told you in historical perspectives. Then 2000 Cg-Mba committee came and they said something. 2003 Narayana Murthy committee came, they said something. And 2013 Companies Act was totally overhauled and detailed rules and regulations were given. So you can say the present structure of corporate governance in India is more or less guided by the 2013 law, Company Act, which is influenced by all this. This is the environment outside and external and internal environment affecting corporate governance in India. Okay, so there are government regulations, corporate culture, structure, all that. And Companies Act, SEBI, stock exchange, they control. Then there are shareholders, auditors, and board of directors. These three are the main stakeholder of the corporate governance system. In addition, there is one company secretary. So company secretary is the coordinator for the board of directors, and there he or she is the complying officer. And what this CG corporate governance system results in: proper governance, shareholders value addition, investor protection, healthy corporate sector development, and customers concern. So these regulations help in getting this, achieving this. Can you see the movement of my mouse?
Yes, sir.
Yes, sir, we are able.
I was trying to highlight, so I didn't know. Okay, it is good. So then, if you remember this slide, so Cg-Mba committee came in 2000. Okay, 1997-98 CII did that, and then Cg-Mba committee came. This committee brought, so we will be reading about its recommendations and all. The Cg-Mba committee has given 25 recommendations. Out of that, 19 are mandatory for listed companies. Then I don't know if you are aware, there is a categorization of companies based on capitalization on the BSE and NSE. Or that the Group A companies are mainly targeted because they are the one where money is there. So the Group A companies, as on 1st January 2000, has to have to adopt these 19 mandatory recommendations of Cg-Mba committee by March 31st, 2001. They have done it. Some of them failed, but now they have done it. And then again, there are further recommendations by N.R. Murthy and all. Then disclosure norms for IPOs. So that was also in detail, it was given by, yeah. Yagyaseni madam kon कहूले? So IPO norms were more given in more detail, so that when somebody is trying to invite the public to invest, the information should be proper. Presentation of information on utilization and end use of funds. If you are bringing an IPO, then you have to also ensure this, that the end use is for the purpose for which you have requested that fund. Suppose you want to invest in expansion, you bring that fund, but you invest in something like, modernization or infrastructure or something else, which is not what you promised in the IPO, then that will be held against you. So you have to be very careful of utilization of the fund raised through public offer. Statement on cash flow in balance sheet. You have to clearly say in the balance sheet that what is the expected cash flow, and you have to show all that figure and all. And also show this money coming from IPO in your balance sheet and how it is used. Declaration of unaudited quarterly results. That is what I informed that in India, it is 4 times a year. Every quarter, 3 months, these results have to be declared. This may be unaudited, need not be audited at the time of declaration, but otherwise later on it gets audited. These regulations cover 80% of the market capitalization because it was covering the category A of of BSC and NSC. So effectively 80% of the market capitalization was covered. Details regarding directors and their remuneration, this was also to be given. Details of the audit committee, how the audit committee will function and who will head the audit committee, all that details were given. Then shareholders grievance committee also came up. These committees are subcommittee of the board, means directors are there in these committees. The company secretary can help or some other officer which can be designated to help this committee, but the members will be some members of the director. Then general shareholder information. You have to give a general information on the pattern of shareholders, and in most of the companies, you give a information up to a particular percentage of holding. So what are the 19 mandatory recommendations? The constitution of audit committee and remuneration committee in all listed companies. Remuneration committee decides about the remuneration of the directors as well as the managers below. And it has to be there. Means a subcommittee of the board had to look into remunerations and audit. Appointment of one or more independent directors in them. Means these committees should have one or more independent directors, apart from the regular executive directors. Recognition of the leadership role of chairman of a company. Enforcement of accounting standard. Actually, the chairman of a company has a veto, because he is the deciding factor. If he decides on something, generally the board will follow that. Enforcement of accounting standards. Here that internal financial control can be related to this. The obligation to make more disclosure in annual financial reports. Effective use of power and influence of institutional shareholders and so on. Presence of the chairman of the audit committee in all AGM. Presence of the chairman of the audit committee in all AGM to answer shareholders' queries. Company secretary to act as the secretary to the audit committee. Audit committee meet at least thrice a year with requisite quorum. Powers to audit committee to investigate and any activity within its terms of reference to seek information from anybody. Discharging of various roles such as reviewing any change in accounting policies and practices, etc. is part of audit committee. Board of directors to decide the remuneration of non-executive directors based on the remuneration committee recommendations. Full disclosure to shareholder regarding remuneration of all directors. This is not the cumulative figure. Individual directors figure have to be given. Board meeting at least 4 times a year, which is there in Company Act now. Director not to be a member in more than 10 committees or act as the chairman of more than 5 committees across all companies in which he is a director. This is not for the only the company in which we are talking of committee, but generally a director cannot be member of 10 committees and chairman of more than 5 committees across the companies where he is working. Actually, in India, 12 is the maximum limit for one director to be in 12 companies. There are also other restrictions. Bigger companies mean you have to be in lesser bigger companies means the director has to be in less board, not even 12. We'll see that. Resume of director expertise and directorship in companies be provided in case of appointment of a new director or reappointment of a director. Actually, every 2-3 years or even in 1 year, some directors are changed. And at the time of AGM, the directors are appointed or reappointed. At that time, you have to give a small CV of them to the shareholders. In the AGM notice, all that has to be part of the AGM agenda. Then board committees for redressal of shareholders' complaint. Separate section on corporate governance in the annual reports with a detailed compliance report. Next, what are the non-mandatory? How many non-mandatory recommendations are there for Cg-Mba Group committee? There were total 25 recommendations. Out of that, 19 were mandatory. So 6 recommendations were non-mandatory. The board should set up a remuneration committee to determine the company's policy on specific remuneration packages for executive directors. Half-yearly declaration of financial performance, including summary of significant events in the last 6 months, should be sent to each shareholder. Means if you send to each shareholder, it is okay. If you don't, it is okay. But half-yearly, it is optional. But big companies do that. Non-executive chairman should be entitled to maintain a chairman's office at the company's expense. This will enable him to discharge the responsibilities effectively. But who is a non-executive chairman? Can somebody tell me? Or what is the definition of a non-executive chairman? Non-executive means who is not working on full-time basis. He is a chairman of the board, but only attends the board meetings or whenever called for or required. So that type of chairman and is entitled for a home office. You know why these rules are there? Many companies, the promoters exploited these points and spent a lot of money in refurbishing their house, saying that this is home office. So all that has been now regulated. Then next is Narayana Murthy Committee. Do you remember the date when it was, the year in which it started? It was done in 2003. Earlier was 2000, then 2003. Narayana Murthy, are you aware who is Narayana Murthy?
Founder of Infosys.
And also was the executive chairman before this Nandan Nilekani took over. Okay. And he was chairman also earlier when he was director and chairman. Then he took retirement. After that, there were others. And when the company was in trouble, he became the non-executive chairman. And his son was brought in as a director. He tried to set right the companies. He's one of the pioneer modern day entrepreneur, you can say. Terms of reference is what was the committee supposed to look into? To review the performance of corporate governance and to determine the role of companies in responding to rumor and other price sensitive information circulating in the market in order to enhance the transparency and integrity of the market. Now, to review the performance of corporate governance means whatever corporate governance mechanism has been devised from 1978 till Cg-Mba committee's recommendations and all that, they have to review all that and say if there is any change or modification required. So, and the other one was how to address, how the companies should address rumors and all, because I don't know if you go through newspaper, when you go through newspaper, you know, mainly in Financial Express or Financial Times, the pages where financial informations are given, you will see some statement like some speculation about a company doing certain things. And there can be a rider like that the company was approached, but no information, no answer has been received so far. Even you will find also one statement like SEBI has been, our reply to our question to SEBI has not been replied, something like that. So, but it was, before that it was like, the company didn't have any guideline to respond. So now our Murthy committee looked into that. And the committee discussed about audit committees, audit reports, independent directors, related parties, risk management, directorship and director compensation, code of conduct and financial disclosure. The committee recommendations in the final report were selected based on their relative importance, fairness, accountability, transparency, ease of implementation, verifiability, and enforceability. The key mandatory recommendations is focused on strengthening the responsibilities of audit committee, improving the quality of financial disclosure, including those concerning related party transactions and proceeds from initial public offering, IPO. What is related party transactions?
Sir, related party transaction, it could be anyone relative to directors, board of members. It could be related, one subsidiary company and both and parent company. It should be whatever transaction, so that a related parties you can say.
Related party, if you are talking of relation can be which is, as you said, somebody related to you by blood or by that is one. But related party transaction basically is when both the parties have mutual interest. That is called related party transaction. If you have mutual interest for each other, then there is a possibility that there will be fraud. You may, someone may make benefit, someone may make loss. So overall, some people may get affected, some shareholder may get affected. So yes, whenever there is there are interests of each party in one matter, that should be clearly brought out. That should be clearly informed. That should be clearly explained. That is it. Because a company is there, you have no relation, neither, but you can still have relation like friends. When the promoter knows you and you want to give him benefit, he wants to give you benefit, and you can do something which is not in the best interest of the shareholder. So those type of practices are related party transactions.
Yes, sir. But as per company law point of view, it's related person or could be parent company and subsidiary company also. And if one director and
tell me why parent company and subsidiary company will be related party transactions.
Sir, I'm just giving one example of that. If I am as a parent company established in India, okay, and I have one subsidiary in US, and on behalf of subsidiary as a parent company, I have done one transaction. So anything like on behalf of subsidiary, sir, subsidiary parent is just like a father and subsidiary just like a son, right, sir? So I can, if I have done any kind of transaction on behalf of my subsidiaries, and their transaction as per audit point of view, as a company law point of view, that will be called as per my knowledge related party transaction also.
See, like if you have a subsidiary in US.
Yes, we have 6, because as per what, sir, I'm saying as per my practical knowledge, because you have 6 subsidiaries out of India, and we are the parent company right now in India, and we have 6 subsidiaries in UK, Canada, North America.
I am not denying anything, but I am only saying, why are you saying that this is a related party transaction? See, when you have a subsidiary,
yeah,
why there will be no transaction? Why have you set up a subsidiary in US or Canada or wherever?
But this is as per our client requirement, and there should be a local entity as per your client requirement, and we are just following whatever local.
I understand, but that is an extension of your company.
Yes, sir, correct, sir. But
so,
sir, related party.
You talk of fraud, it is like, see, I have invested in some other outside. I have a business in US. Now the US law says that I have to have a company there. But that company is owned by who? The parent company.
Yes, sir. That's, as I said, sir, there is no, I'm sorry, sir, there is no fraud, because whatever we are doing as per law, and it has been mentioned, if sir, there is some law, you can just see there is one standalone balance sheet and one is consolidated balance sheet. And all the has been as per the law and rules and regulations. There is no fraud, sir, as per my knowledge. I'm sorry, sir, but this is the.
But you are bringing with a point which I don't think is really targeted by this related party transaction issue.
Yes, sir.
Related
Sir,
part-
what we are doing and following the
No,
president.
that is okay. That is what is done. That is what I am also trying to say. See, you have made a company in US, Canada, or wherever
Yes.
to further your business, because that was the requirement. Otherwise, you would not have done. Suppose a country doesn't allow, doesn't require that you have to form a company there. You can have an office and start doing business. Nobody
Yes.
can stop you from it.
Yes,
But if
yes, sir. But there are some rules and there are some clauses that we have to, as a parent company, you have to support to our
the
subsidiary
consolidated balance sheet, individual balance sheet, these are all different issues. That is why I'm saying, please don't confuse with related party transactions when we are talking of these guidelines. Related party transactions, why the emphasis on disclosure on related party transaction is. Suppose I will tell you one thing.
Yes, sir.
Like you have a company in US, suppose,
Yes,
and you are in India. There is a benefit, tax benefit in some way. You are by tax or something, you are getting more benefit in US than in India. Now in that, ये कहाँ migraine somebody should try to be careful about this, because this doesn't make sense. যদি এই প্রকার সাউন্ড ফাউন্ড হবো তাহলে আপনাମାନଙ୍କୁ ସମସ୍ତଙ୍କୁ ଅନମ୍ୟୁଟ କରି ମ୍ୟୁଟ କରିବା କଥା ଯୋଉ ଥିଲା ମୁଁ ସେଇଟା ହିଁ ରେକମେଣ୍ଡ କରିବି. Please be careful. We know we are in home and all that, but we can still be more aware. What I was trying to tell you, if by floating a subsidiary in a country where you to just extract or manipulate profit or manipulate your earnings, then that can be termed as a related. And that is why you have to, when you have a subsidiary, you have to declare. I am not denying that. What you are saying is not what the essence of these rules and regulations. The essence of rules and regulation is that, when this related party transactions were not detailed way, it was not included in the declaration and all that, people made money just for the sake of making more profit. They don't need to have a company somewhere else, but there are tax havens. As you know, what happened to Adani's investment, which there was a lot of hue and cry. There are companies in those countries which are more or less shell companies. They do not do any business, but people float those companies only to circulate your money and bring in at cheaper rate. So these are the cases where related party transaction has to be very clearly. But suppose Infosys India has to make a company. What is the name of your company?
It's RMSI Private Limited IT company. It's since 1992.
So that is what I'm saying. So there, if you have to have an office, it is like an extension of your company here and there. So you have to give the declaration. But this was not for those companies. The mandatory recommendations of Narayan Murthy was to avoid fraudulent practices in related party transactions. Okay. I can give you an example. There is a company, a ferroalloys company. They have a mines in Madagascar in a different name. Okay. The owners are same. The Indian company is here in India. There is a company in Austria, in Europe, which does the trading. And the mine in Madagascar is owned by a company in Singapore. What these people were doing, these Indian operations, they were making it look like, operate, make loss. Or they were trying to minimize the margin for the Indian party. How? They would sell the ore to Indian company at a higher rate because international rates are there, but they will not negotiate because their own company. So what they are doing in Madagascar, things are different. If you make more profit, you can take it, you can do better things. In
Yes,
India,
yes.
there are taxes and all that. And
Yes,
what
that's
they were,
correct.
when they were selling this product to for Europe, they were only trading through their company, which was registered in Belgium or Austria.
Yes,
Now,
sir, that's correct.
so no, I don't know if you have understood. Please wait. Then see what this fellow was doing. This company was doing. They were making this Indian company look like sick, but they were making profit at Madagascar and at Austria. So they were trying to, in a way, they were doing business in India. They were producing, they are using our resources, like they were taking iron ore from OMC. They were, people are from here, other raw materials they were taking everything, and they would project a balance sheet where they will show that their company is at loss. So to avoid tax, and by selling the final product to Europe, they were exporting agreed, but that trading house which they have form of their own ownership, some of them were there. The trading house was making huge profit. Similarly, Madagascar mines was making huge profit. So this is what is to be objected.
Okay.
Understood what the emphasis of related? It is not for normal business. Don't get confused with that. If you are doing business in other countries and where you are required to do have companies as per their law, it is okay. But that doesn't mean that you will be doing like this. But this is the example of related party transactions which were targeted by these committee, and many companies have been doing and are doing till now.
Okay.
Requiring corporate executive boards to assess and disclose business risk in annual reports of companies, introducing responsibilities of boards to adopt formal codes of conduct, stockholder approval, and improved disclosure relating to compensation paid to non-executive directors. The non-mandatory recommendations are moving to a regime where corporate financial statements are not qualified. Not qualified means they are more clear. They are in normal, everybody should be able to understand. You do something. Yesterday I was reading one article. There is a difference between what RBI measures on inflation and others, and what the Ministry of Finance measures, the way they measure. There are two different things. Now, if suppose RBI says something and Ministry of Finance has the same, for the same data has a different figure, then it becomes difficult. So that is why it says financial statements should be as simpler as possible without any further qualifications. Instituting a system of training of board members and evaluation of performance of board members. Okay. Then next is this clause 49.
Sir, I have a doubt. Sir, I have a doubt related to related party transaction. Sir, is there only two party to be formed the related transaction, or it can be expanded?
It can be any party. There are so many stakeholders. There are so many transactions taking place. So everywhere you have to avoid related party transactions.
Yes, sir. Is there any specific limit of parties that X parties can join, Y party can join? Is there limit, or it can be unlimited?
Your question is not clear to me. X
Sir, I am
party,
saying,
number
no,
of
sir, I am
parties.
saying, sir, number of parties. It is specific. There is specific laws of joining of parties, or it can be unlimited. Hello, sir.
Who context रे कहउछन्ती?
सर मु कहली कि सर जो हमर पार्टी अछंती जेतिक हमर जो रिलेटेड कांटेक्ट रिलेटेड जो ट्रांजैक्शन जो मन रही रिलेटेड ट्रांजैक्शन में से माने अधिक आइ परिबे ना सीमित कि स्पेसिफिक थाइ कि इतिक जन जॉइन करिवे केतिकी करि परिबे अधिक करि परिबे ने
नहीं, any transactions of company between two parties, there was a guideline to avoid, who can be a related, what can be defined as a related party transaction, ता विषय guideline अछि. एथर number of parties रो किछि restriction नहीं. को transaction related party transaction बोली कुहा जिवो सीटा अछि.
Okay, sir, got your point.
Then next is LODR, एगुडा अछि listing agreement. तारो ए जो clause 49 थिला सेटा को भी Narayan Murthy committee noted that the recommendations contained in their report can be implemented by means of an amendment to the listing agreement. जोटा कि आदित्य KM Birla group already करथला, माने से clause 49 को amend करिया को भी लिखिथिले. Then there was another committee called Naresh Chandra committee, which was formed by Ministry of Corporate Affairs. These two, Narayan Murthy and K.M. Birla, were formed by SEBI. I don't think we have time, but we have not been able to finish. I don't know. Anybody is there from DDC?
Yes, sir.
Arey, our time achi 5 minutes na, we will close.
Oh, sir, sir, ଆସିନାହାନ୍ତି ଆସିଲେ inform କରିଦେବି sir.
ଆସିଲେ ମତେ କହିଦବ. ଆସିଲେ ମତେ କହିଦବ.
ଆଜ୍ଞା sir, sir.
So,
Sir, please continue. Not interested to leave the class.
Sir, ନହେଲେ ଥାଉ sir ଆସିଗଲେଣି next class ରେ
ଆସିଗଲେଣି?
continue। ଆଜ୍ଞା।